BVI, open-ended funds and approved funds, structures, benefits, and approval process. The British Virgin Islands is one of the world's leading jurisdictions for the formation of investment funds. With a well-established regulatory framework, tax-neutral environment, and efficient approval processes, the BVI offers a compelling platform for fund managers, particularly those launching their first fund or structuring vehicles below $100 million. This guide explains the key open-ended hedge fund categories available in the BVI, the benefits they offer, the regulatory requirements involved, and the step-by-step process for obtaining fund approval. What are BVI investment funds? A BVI investment fund is a pooled investment vehicle incorporated or established in the British Virgin Islands that collects capital from investors and deploys it in accordance with a defined investment strategy. BVI funds are regulated under the Securities and Investment Business Act 2010, revised, SIBA, and overseen by the BVI Financial Services Commission, FSC. BVI funds can be structured as companies, the most common form, limited partnerships, or unit trusts, offering flexibility to match the preferences of both managers and investors. Under SIBA, investment funds fall into 5 recognized categories: incubator funds, approved funds, private funds, professional funds, and public funds. Each category has different investor eligibility thresholds, minimum investment requirements, regulatory obligations, and validity periods, allowing managers to select the structure that best suits their fundraising strategy and investor base. Incubator funds and approved funds are particularly suited to emerging managers with assets under management below $20 million and $100 million respectively. What is a BVI approved fund? An approved fund is a category of BVI investment fund designed for emerging managers seeking a cost-effective, regulated fund structure with light ongoing obligations. Unlike professional or private funds, approved funds benefit from a fast-track approval process, enabling them to start business 2 business days after submitting a complete application to the FSC. To qualify as an approved fund, the vehicle must have no more than 20 investors and net assets not exceeding $100 million. There is no minimum initial investment requirement. The approved fund must appoint an administrator and a BVI authorized representative, but is not required to appoint an investment manager, custodian, or auditor. The approved fund category is particularly popular with emerging managers who want a regulated fund product with lighter ongoing obligations and lower costs than private or professional funds, while benefiting from an unlimited validity period. Key benefits of investing in BVI funds and approved funds. The BVI offers several practical advantages for both fund sponsors and investors. Understanding these benefits helps explain why the jurisdiction remains a top choice for global fund formation. Tax neutrality. BVI funds are not subject to income tax, capital gains tax, withholding tax, or stamp duty in the BVI, allowing returns to flow to investors without an additional layer of jurisdiction-level taxation. Regulatory credibility. Funds regulated under SIBA and supervised by the FSC benefit from a recognized and respected regulatory framework. This can be an important factor for institutional investors conducting due diligence on offshore vehicles. Speed and efficiency. The BVI approval process is well established, and with proper preparation, fund approvals can typically be obtained within a matter of weeks rather than months. This allows managers to move quickly from structuring to fundraising. Structural flexibility. BVI law permits funds to be structured as companies, limited partnerships, or unit trusts, with wide latitude in governance arrangements, share classes, fee structures, and investor rights. This flexibility is especially valuable for managers with bespoke strategies or non-standard investor arrangements. Cost effectiveness. Compared with many onshore jurisdictions, the costs of incorporating, licensing, and maintaining a BVI fund are competitive, making the jurisdiction accessible for smaller or first-time managers who need to manage launch budgets carefully. Familiarity and market acceptance. The BVI is one of the most widely used offshore fund jurisdictions in the world. US and international investors, administrators, and prime brokers are well versed in BVI structures, reducing friction during fundraising and onboarding. Regulatory requirements for setting up a BVI fund. All BVI investment funds must comply with SIBA's requirements. The specific obligations vary by fund category, but the core regulatory requirements for establishing a fund in the BVI include the following. Entity formation. The fund vehicle must be incorporated or established in the BVI. Most funds are set up as BVI business companies under the BVI Business Companies Act 2004, revised, though limited partnerships and unit trusts are also available. Fund recognition or approval. The fund must be recognised by or receive approval from the FSC under the applicable SIBA category. This involves submitting an application along with the required documentation. Service provider appointments. Depending on the fund category, the fund must appoint certain regulated service providers. These typically include an investment manager, licensed in the BVI or a recognised overseas jurisdiction, an auditor, a custodian or prime broker, an administrator, and a registered agent in the BVI. Offering documents. The fund must prepare an offering memorandum or equivalent disclosure document that, depending on the fund category, sets out the investment strategy, risk factors, fee arrangements, investor rights, and other material terms. This document must be filed with the FSC as part of the application process. Anti-money laundering compliance. All BVI funds are subject to anti-money laundering and counter-terrorist financing requirements under BVI law. The fund and its service providers must implement appropriate Know Your Customer (KYC) and due diligence procedures. Ongoing obligations. Once operational, BVI funds must comply, depending on the fund category, with continuing obligations, including the filing of annual returns, the maintenance of proper books and records, and the submission of audited financial statements to the FSC. How to obtain approval for a BVI fund. Step-by-step process. The process for obtaining FSC approval for a BVI-approved fund is straightforward, but requires careful preparation. The key steps are as follows. 1. Appoint legal counsel and key service providers. Engage BVI legal counsel to advise on the appropriate fund structure and category. Identify and engage the investment manager, administrator, auditor, and custodian as required. 2. Determine the fund structure and category. Work with legal counsel to determine whether an approved, professional, or private fund is most appropriate. Consider the target investor base, minimum subscription amounts, and the level of regulatory oversight desired. 3. Incorporate the fund vehicle. Form the BVI entity, typically a BVI business company, through a licensed, registered agent. Incorporation can usually be completed within 1 to 2 business days. 4. Prepare the offering documents, or disclosure. Draft the offering memorandum, or disclosure, setting out the investment strategy, risk factors, and material terms. Prepare the constitutional documents, memorandum and articles of association or limited partnership agreement. Finalize subscription documents and any side letters or ancillary agreements. 5. Submit the application to the FSC. File the completed application form together with the offering memorandum or disclosure and constitutional documents. Include details of the appointed service providers and due diligence information on the fund's principals. Pay the applicable FSC fees. 6. FSC review and approval. The FSC will review the application and may raise queries or request amendments. Once satisfied, the FSC will issue written approval and the fund may begin accepting investor subscriptions. Typical timeline for BVI fund approval. The overall timeline from initial engagement to fund launch will depend on the structure's complexity and the responsiveness of the parties involved. As a general guide, the key phases are as follows. Structuring and service provider engagement. 1 to 2 weeks. This phase involves selecting the fund structure, engaging service providers, and agreeing on commercial terms. Document preparation, 2 to 4 weeks. Drafting and negotiating the offering memorandum, constitutional documents, and subscription agreements. The length of this phase depends largely on the complexity of the fund's terms and the number of stakeholders involved in the review process. BVI, hedge funds. The 5 fund categories. SIBA recognizes 5 categories of regulated investment funds in the BVI. Each is designed for different types of investors and managers and carries different regulatory requirements. The key differences are summarized below. Incubator funds are aimed at startup managers looking to establish a track record and test a strategy in the most cost-efficient manner. An incubator fund must have no more than 20 investors, each making an initial minimum investment of $20,000, and net assets must not exceed $20 million. Incubator funds benefit from light regulation, very limited mandatory service providers, and no requirement to conduct an audit. The validity period is 2 years, with a possible extension of up to 12 months, after which the fund must convert to a private, professional, or approved fund, or wind up. Incubator funds benefit from a fast-track approval process, enabling them to start a business 2 business days after submitting a complete application to the FSC. Approved funds are intended for managers looking to establish a fund through a private offering to a small group of investors on a longer-term basis. An approved fund must have no more than 20 investors and net assets not exceeding $100 million. There is no minimum initial investment amount. Unlike incubator funds, approved funds have an unlimited validity period. Approved funds are required to appoint an administrator, but are not required to appoint an investment manager, custodian, or auditor. Like incubator funds, approved funds benefit from a fast-track approval process, enabling them to start business 2 business days after submitting a complete application to the FSC. This makes them well-suited to emerging managers below $100 million who want a regulated fund product with lighter ongoing obligations. Professional funds are restricted to professional investors, generally defined as persons whose ordinary business involves the acquisition, disposal, or holding of investments, whether as principal or agent, or who have a net worth exceeding $1 million or its equivalent. Professional funds must file for recognition with the FSC, but the process is simpler than for approved funds. A professional fund is deemed recognized once the application is filed and the applicable fee is paid. There is no requirement for prior FSC approval before launch. Professional funds must also appoint a licensed or recognized investment manager and an auditor. Private funds are limited to no more than 50 investors and may make a private invitation to subscribe for shares or interests. Like professional funds, private funds are deemed recognized once the application is filed and the fee is paid, with no prior FSC approval required. Private funds have the lightest regulatory requirements of the 3 categories and are commonly used for closely held investment structures, such as single-family vehicles or co-investment arrangements. Public funds are generally viewed as retail products and are subject to a considerably higher regulatory burden than the other fund categories. Public funds must be registered by the FSC before they carry on business and are not subject to any BVI restrictions on the categories or number of investors they may invite to invest in the fund. Registered public funds may not make an invitation to the public or any section of the public to purchase shares unless they first publish a prospectus which complies with SIBA and the Public Funds Code. The choice between these categories is typically driven by the profile and number of target investors, the assets under management, the desired speed to market, and the level of regulatory burden the manager is willing to accept. Managers with assets under management below $100 million will often find the incubator fund or approved fund categories most attractive due to their lighter regulatory requirements, lower costs, and fast-track approval process. Managers with a larger, more sophisticated investor base may prefer the professional fund category, while those seeking the widest possible investor base will need to consider the public fund route. How Harneys can help. Harneys is one of the leading offshore law firms advising on BVI fund formation. Our investment funds team regularly advises emerging and established managers, family offices, and institutional sponsors on the structuring, establishment, and regulatory approval of BVI investment funds across all 5 SIBA categories. Whether you are launching your first fund or expanding an existing platform into the BVI, we can guide you through the process efficiently and cost-effectively.